Welcome to this video on equity curve and CAGR. In the previous section on trade-level analytics, we observed that the trade-level metrics only consider the entry and the exit prices. But they don't consider what happened between the entry and exit time of the trade. In order to understand the strategy's performance within a trade, we need to analyze some other metrics as well. With this in mind, Sophie asks John, which metric can she use for a quick analysis of a strategy's performance? John informs her that she can visualize the journey of these different trades from start to end through an equity curve. John further plots the strategy's cumulative returns over 12 years, and explains that the equity curve is a graphical representation of the performance of a strategy over time. He further says that the equity curve shows a summary of all the trades made during this time period, as well as what happened within these trades. Sophie then tells John that through the equity curve, she can also find out the return generated by the strategy throughout the time span of 12 years. The cumulative return at the end of the strategy is 1.9, and if she invests a capital of $100 at the beginning of the strategy, her capital will have grown by 1.9 times, which equals $190. John agrees but then asks Sophie, how can she calculate the average annual rate of the strategy? Or on average, how much returns will this strategy generate per year? Sophie says that she can calculate that by taking the average of the yearly returns. John tells Sophie that this is not correct and she's missing out on one important piece of information. And he continues to explain this to Sophie with the help of an example. Let's suppose we invested $10,000 in this strategy for 2 years. At the end of 1 year the strategy value falls to $7,500. At the end of second year, its value again rises to $10,000. In the first year, the strategy return is minus 25%, and in the second year, its return is 33%. When we calculate the average return, we find that it is 4%. John asks Sophie if she is convinced that the strategy generated a return of 4%. Sophie tells John that a return of 4% is incorrect. Because we started with a capital of $10,000 and ended with a capital of $10,000, which is a return of 0%. John tells Sophie that she is correct, and the metric that she should look at is CAGR, and not the average annual return, as the CAGR is a better metric. As Sophie is unaware of this metric, John further explains that the CAGR, or compound annual growth rate, measures the average rate of an investment's growth over a period of time, with the effect of compounding taken into account. And CAGR can be calculated by using the following formula. John further adds that in the previous example, if we have to calculate the CAGR, we will divide the beginning value of $10,000 by the ending value of $10,000, raised to the power 1/2, minus 1, which will give a CAGR of 0%. Sophie then tells John that analyzing just the returns does not seem convincing enough, because she knows nothing about the risk associated with this strategy. John agrees with this, and informs her that to analyze both risk and returns associated with this strategy, we will have to analyze a metric called Sharpe ratio. To learn about the Sharpe ratio, stay tuned for the upcoming video unit. Welcome to this video unit on the Sharpe ratio. In the previous video unit, we understood that analyzing a strategy just based on returns is not enough. A strategy with high returns is not necessarily very attractive, if it has a high risk associated with it. John tells Sophie that it is better to analyze the returns per unit of risk, compared to analyzing just the returns. John further adds that Sophie can analyze the returns per unit of risk by calculating the Sharpe ratio, which is the ratio of the mean return that the strategy produces, over the risk-free rate per unit of volatility, or standard deviation of the strategy's returns. Sophie asks John to elaborate on the interpretation of this ratio. John explains this with the example of two strategies A and B. After backtesting, strategy A generates a return of 11%, but the standard deviation of the strategy returns is 8%. Similarly, Strategy B generates a return of 8%, but the standard deviation of the strategy returns is 4%. Considering the fact that the risk-free rate of return is 3%, the Sharpe ratio for strategy A is 1, and the Sharpe ratio for strategy B is 1.25. John then asks Sophie which strategy she thinks performed better. Sophie tells John that strategy B performed better, because even though the return generated by strategy B is lower compared to strategy A, strategy B takes a lower risk, and hence generates higher returns per unit of risk, as indicated by the higher Sharpe ratio. John agrees with Sophie, but further adds that concluding that a strategy is better by just analyzing the Sharpe ratio is not correct. She should also look at the extreme losses, or the tail risk of the strategy to conclude which strategy is better. That is all for this video. In the upcoming video unit, we will learn about the maximum drawdown. Welcome to this video unit on the maximum drawdown. In the previous video unit, we learned about how the Sharpe ratio can be used to evaluate a strategy. John mentioned that concluding a strategy is better by just analyzing the Sharpe ratio is not correct. You should also look at the extreme losses generated by the strategy to conclude which strategy is better. John tells Sophie that along with the Sharpe ratio, she should also look at the maximum drawdown. Sophie further asks John what is maximum drawdown, and why it is important. John explains that the maximum drawdown is the maximum observed loss from the highest peak to the next lowest trough. For any strategy, it can be calculated by subtracting the peak value from the trough value, and then dividing it by the peak value, which in this case, is around 34%. Along with the Sharpe ratio, analyzing maximum drawdown is important. Because the Sharpe ratio does not give any information about the maximum loss a strategy can incur. To explain this better, John further continues with the same example of strategies A and B, with the Sharpe ratio of 1 and 1.25, respectively. But this time, he introduces some new information. It was observed that after the COVID-19 pandemic, the maximum drawdown of strategy A was 30%, and for strategy B, it was 60%. Strategy A is more volatile, and has a lower Sharpe ratio compared to strategy B. But strategy B has a higher chance of incurring a catastrophic loss, because strategy B's maximum drawdown is way higher than strategy A's. John now asks Sophie which strategy she thinks is better. Sophie tells John that strategy A seems to be a better choice for her, because she is more comfortable with a 30% loss compared to a 60% loss. And for that, she is satisfied with a strategy with a marginally lower Sharpe ratio. John agrees with Sophie, and adds that to evaluate a strategy, you must analyze both the Sharpe ratio and the maximum drawdown, and decide accordingly. That's all for this video. In the next section, we will learn about risk management. Welcome to this video on stop loss and take profit. In this video, you will learn about the logic behind setting a stop loss and take profit level. John has computed the maximum drawdown of his strategy. He notices that there were certain instances where the prices dropped by more than 15%, resulting in extreme losses. Now he starts to wonder if he has followed all the rules and has entered and exited as per the strategy conditions. Why did he make losses in the first place? And whether there is a specific reason for these losses. He decides to randomly pick a trade to analyze what went wrong. This is the chart for the S&P 500 index during the period February 2022 to June 2022. We have already applied the moving average indicator. The orange line is the short-term moving average, and the blue line is the long-term moving average. On the 21st of March, the entry condition has been met. The price on this day was $4,459. On the 12th of April, the exit condition was met. Here the price was $4,395. So he has incurred a minor loss with this trade. Let's try to understand why this happened. Initially, the strategy was working well. The prices were moving in his favor. But around this time, for 2 consecutive days, the prices dropped. Let's see what happened on this date, that is the 31st of March 2022. The prices actually dropped in reaction to a recent event, specifically due to the Russia-Ukraine conflict. But this was just for one of the trades. There are multiple trades, with multiple reasons for sharp price drops, such as the pandemic breaking out, or unsatisfactory quarterly reports. Since the technical indicator is not reacting as quickly, it's resulting in losses that could have been avoided. John seeks his friend Sophie's advice, and asks if there is a system which would shield his capital from extreme losses. This system should be applicable to all the trades, not just one. Sophie suggests that he can set a fixed stop-loss and take-profit level for all the trades. She goes on to explain the concept of stop-loss and take-profit. In this particular example, we have entered a trade at $100. Now let's say that he cannot afford to lose more than $10 on his capital. In that case, he should set a stop-loss $10 below, or 10% below his entry price. On the other hand, to achieve maximum gains, he can set a target level of 20% above the entry point. So when the price reaches $120, he will book his profit and exit. The fixed level of exit above the entry price is the take-profit level, and the one below is the stop-loss level. Then she prompts John to set his own stop-loss and take-profit level. He decides that he wants to limit his losses to the bare minimum, and at the same time, gain as much profit as possible. So he sets a stop-loss 5% below the entry price, and a take-profit 30% above the entry price. Can you spot any problem with these levels? There are 2 problems here. First, let's look at the stop-loss. The problem with the stop-loss is that it's too close to the entry price. The probability of this stop-loss getting hit is quite high, and therefore, he might end up exiting the trade too soon, without even getting a chance to make any real gains. A stop-loss that is too close to the entry price may increase the number of losing trades. Now let's look at the take-profit level. The problem here is that it's too high, almost impossible to reach. So the probability of the price reaching this level is very low. This level might never even get hit, and you may not be able to book any profits at all. These levels are quite unrealistic. In fact, in this case, the stop-loss has been hit thrice, whereas the take-profit has not been hit even once. Sophie explains to John that he needs to set appropriate stop-loss and take-profit levels. But John is confused, so he asks Sophie to guide him. To learn about certain guidelines that you should follow while setting stop-loss and take-profit. Stay tuned for the next video. Welcome to this video on guidelines for setting stop-loss and take-profit. After understanding the concept of stop-loss and take-profit, John had set these levels as per his preferences. But Sophie pointed out that the levels were not appropriate. He should follow certain guidelines while setting these levels. She goes on to explain that the price range should be analyzed first. The level should not be exposed to frequent price fluctuations. At the same time, it should be reachable. She suggests that he can set a stop-loss or take-profit based on a risk-reward ratio. Risk-reward ratio defines the level of risk you are willing to take in exchange for a certain level of reward. To explain further, if the risk-reward ratio is 1:1, then the possibility of reward is $10, and the risk of loss is also $10. For example, if you are entering at $100, you will set a take-profit of $10 above the entry price at $110, and a stop-loss of $10 below the entry price at $90. On the other hand, if the risk-reward ratio is 1:2, the possibility of a reward is $10, but the risk of loss is $5. Here, if you enter a trade at $100, you will set a take profit of $10, above the entry price, at $110. But you will set a stop loss of $5, below the entry price, at $95. According to the levels that John had set earlier, his risk-reward ratio works out to 1:6. This ratio is too skewed. And ideally, the ratio should be somewhere around 1:3. John thinks it would be better if he sets these levels after entering a trade. This way, he can study the market while trading, and accordingly set the appropriate levels. Sophie warns him that this would not be the right move. She explains that after entering the trade, he would be emotionally invested, and could get influenced by emotions like greed and fear, which would eventually lead to irrational decisions. She explains that when he is not invested emotionally, he would have a clear thought process and can take better decisions. So it's always better to set these levels before entering a trade. To summarize, setting a stop loss and take profit limits your losses and helps you exit at an ideal time. These levels should be set with a realistic point of view, and they should be set before entering a trade. John's strategy originally earned a profit of $1,500. But after taking steps to manage his risk, by setting stop loss and take profit, his profit increased to $1,700. He is happy with the performance, and is now excited to take his strategy live. But Sophie reminds him that before doing that, he needs to account for all the costs and slippages too. And if he's not aware of these concepts, that's okay. Because in the upcoming video units, we will be learning about these concepts in detail. Welcome to this video on data snooping. Initially, you have a trading idea, but you do not go and live trade. You will first test the effectiveness of the idea on historical data. If the backtest shows a good performance, you will move towards paper trading, and further in live trading. But if the backtest results are bad, you should ideally reject the idea. Sophie says that this is a normal process from ideation to execution. But sometimes people cannot let go of the strategy which has given a bad performance. They feel that they can still improve it. They keep trying to find some way to make this strategy work by tweaking the existing strategy. This is not correct, as it can lead to data snooping. What is data snooping? Let's say you have a simple idea, and you formulate the entry and exit rules. You will buy at the market open and sell at the market close. You backtest the strategy, but it gives you negative returns. Instead of rejecting the strategy, you decide on tweaking the exit rule. You will now exit at 1 p.m. When you backtest the strategy with these rules, you are again disappointed at the performance. Now you look at the data, and see that if you enter only on Wednesday, and exit at 1 p.m., it will give good results. But this can be a coincidence or a fluke. Looking at the data and trying to find the favorable results is data snooping. Another example of data snooping is if you try a strategy on 5 different stocks, but it only works on one. You will then remove the other stocks, and keep the stock on which the strategy worked, and mention that this strategy is good, which is not true. It can be just a chance that the strategy is working on the selected stock. Such a strategy might not work as expected in live trading. To summarize, data snooping bias is to create thousands of trading rules and backtest them. You might end up with several rules which lead to a profitable trading strategy. This approach of finding a trading rule is known as data snooping bias. How can you avoid data snooping? One of the ways to avoid data snooping is to divide the data into 2 parts, in sample, and out of sample. You can test those thousands of rules on in-sample dataset, and validate if the results are similar on out-of-sample dataset. You finalize the trading rules which work in both in-sample and out-of-sample dataset. This approach can reduce the data snooping bias. Again, be careful not to overuse this approach. If you keep on doing this repeatedly, That is, generate tens of thousands, or hundreds of thousands of trading rules. Then you will find a trading rule that works both on in-sample and out-of-sample dataset. This trading rule could just be due to fluke profitable. John thanks Sophie for explaining data snooping. And he found a combination that worked on both in-sample and out-of-sample dataset. The strategy is very profitable. He couldn't wait to deploy all his capital on this strategy. Sophie cautions John to not over-rely on backtests. In the next video, Sophie explains to John, with the help of a case study, on the perils of over-reliance on backtesting. Welcome to this video on biases to avoid. After completing this video you will understand look-ahead and overfitting bias. John has created a strategy which is giving him exceptional returns in the backtest. He tells Mary about the performance and she is happy. John mentions that in the strategy, he analyzes the financial report after the earnings have been released, and buys the asset if the company reported more than 10% profit. If the net profit margin is less than 10%, he sells or takes no position. As an example, he shows the earnings result for the year 2021 and the first quarter of 2022. He says that the first quarter results were released on the 20th of April 2022, and the net profit margin was reported as 18%. As the strategy checked it was more than 10%, it gave a signal of buy. Similarly, the past results have been shown on screen. Mary feels it is too good to be true, and asks him at what time the strategy buys or sells the asset. John says that it is on the close of the same day the earnings results are released. But Mary realizes that the earnings have been released after the market has closed. This meant that John's strategy was actually buying at the close price, which was before the earnings were actually released. Mary explains that this is called look-ahead bias. Here, you are looking at the data released in future, and then incorporating it into the present. John realizes this is why this strategy was giving exceptional results in backtests. John asks Mary if there are any other biases he should avoid. Mary replies yes. Let's say you have created a simple strategy involving two moving averages. The short and long simple moving average. The entry rule is that, if the short moving average crosses the long moving average from below, you would buy. And you will sell, if the short moving average crosses the long moving average from above. Or if you reach your take profit or stop loss levels. Initially, you choose 14 days as the short moving average, and 50 days as the long moving average. You backtest this strategy on Tesla for a period of 2 years and get 2% returns. You are not satisfied, and decide to tweak the entry rule. You change the short moving average to 10 days, and backtest this strategy. You see that the returns increase from 2% to 5%. But you still feel that it is low and you try out different parameters. Finally, after changing the period of the moving averages for the 20th time, you find an entry rule which gives 23% returns. Here, the short moving average is of 3 days, while the long moving average is 5. You are happy with this result and take this strategy in the paper trading environment. But the strategy gives a negative return of 5%. How did the performance decline from 23% to negative 5%? This is because you have tried to tweak the rules on historical data. Since you already have the data at hand, you have tried to fit the rules which would work on this data. This means that you have overfitted it on past data, but it doesn't work on the present data now. John thanks Mary and says that he'll keep these in mind when he creates a new strategy. After a few days, John tells Mary that he had created a new strategy. But when he tried it in the paper trading environment, the strategy was not able to fill the orders in the live market. Mary reassures John and says she will check if there were any mistakes in the strategy. We'll look at the mistakes to avoid in backtesting in the next video. Welcome to this video on common mistakes done with trading volume. John had created a strategy which gave incredible returns in his backtest. He was happy and moved towards paper trading. But so far, the strategy has not been able to completely fill the buy orders in the paper trading environment. John tells Sophie that on the 3rd of June, this strategy had given a buy signal, but the order was not completely filled. Sophie asked John how many shares does his buy order consist of. John replies that it is 10,000 shares. Sophie checks the daily traded volume of this stock and sees that the volume is not even crossing 100. She even checks the historical volume traded and the story is the same. This is an illiquid stock. That means that it does not have many buyers or sellers. Therefore, it is difficult to buy 10,000 shares of this stock. John realizes that he was trying to buy more shares than were available in the market. In backtesting, he didn't check for the volume while placing the order. This resulted in unrealistic output from backtesting. In the live market, you will not be able to buy such a high number of shares. What can we do to avoid this? Sophie replies that you can restrict your capital allocation, or number of shares you can buy for such illiquid stocks. And not only illiquid stocks, but you can factor in volume information for all stocks you take positions in backtesting. John checks on the 13th of June the volume traded was 300 and decides to buy 300 shares on the 3rd of June and goes to Sophie to confirm the approach. What do you think? Is buying 300 shares correct? That again won't be a correct assumption to build in your backtesting. If you buy all the volumes which were traded, that would have a very negative impact on the purchase price. There are other players also trading in that stock. To backtest correctly, you should assume that only a certain percentage of the volume you will be able to trade. For example, you can assume that only 1% of the volume traded is available to you. The total volume on the 13th of June is 300. In your backtest, you should buy only 3 shares of that stock. John is not happy and says buying only 3 shares is not sufficient. That is true. Sophie replies. You should discard such illiquid stocks and create your strategy which focuses on liquid stocks. Trading liquid stocks enables you to easily get in and out of the position without significantly impacting the price. John realizes his mistakes and assures Sophie that he will only trade in liquid stocks. And further says that he'll also look at the data to find some patterns in these liquid stocks. Sophie mentions that this could lead to data snooping. In the next video, you will dive deep into the concept of data snooping. Welcome to this video on over-reliance on backtesting. John asks Sophie what happens if you over-rely on your backtest. Sophie mentions that you could lose billions. John is surprised and asks if this has happened before. Sophie tells him about the long-term capital management hedge fund, which was highly successful in the 1990s. It was headed by stalwarts such as Meriwether, and Nobel laureates like Myron Scholes, and Robert Merton. The fund posted annualized returns, after fees, of around 21% in its first year, 43% in its second year, and 41% in its third year. How did they manage these exceptional results? Sophie says they created pairs trading strategy. They used quant models to identify deviation in fair value and took positions that would benefit if the asset price returned to its fair value. They had backtested these strategies on different assets, and the results were very promising. These backtests showed very little drawdown. They were so optimistic of the backtesting results that they had levered 25 times. They had their own money of $4.6 billion but took positions worth $125 billion. John was very excited and wanted to know how the hedge fund was doing today. In 1998 it lost $4.6 billion in less than 4 months, due to exposure to the 1997 Asian financial crisis, and 1998 Russian financial crisis. Their models were correct. But they did not factor in that the market could stay irrational for longer than they could stay liquid. Their backtest couldn't factor in the extreme events. Thus, you cannot over-rely on your backtested strategy. John mentions this is why risk management is important. Sophie adds that one of the aspects of risk management is to keep your leverage in check. In the next video, you will look at the frequently asked questions on backtesting.